right, well, it is 2 o'clock, so we will get started. I'd like to thank everyone for joining today. I am Lori Berman. I'm the Vice President of Membership for the Small Business Association of Michigan. Thank you for being part of today's webinar. We provide these webinars to small businesses across the state of Michigan monthly. We actually had 2 this month, and this one today ends our series for this calendar year. And watch the SBAM website for upcoming ones in the next calendar year. So I am very pleased to have with us today Anita Ebral, who's a CPA and principal from Lewis and Knopf CPAs. Anita is the owner, and Anita is also a member of the SBAM Board of Directors. She comes to us with several years of experience, and we appreciate Anita being a part of today. We also have Linda Senior, who is also a CPA manager. I know that she joined the firm a few years ago, and I know her focus is small business and loves small business. So Lewis and Knopf is a great partner, and hope you will learn something today. For those of you that are on the webinar, you may ask questions as we go along. Go ahead and ask your questions, and I will watch for those and alert our presenters that our questions are out there, so feel free to ask them. We are recording today's session, and it will be available on our website next week. We did have a new labor law webinar yesterday that talked about the changes in the labor wage law regarding exemption, unexempt, and if you want more information on that, that webinar will be on our website next week as well. So without further ado, I will turn it over to Anita and Linda, and folks, feel free to ask questions as we go along. Anita and Linda,
well, thank you, Laurie.
Take it away.
Thank you, Laurie. Thanks for inviting us to do this webinar for you today. Our topic is recession-proofing your business, and we are going to turn the slides on so that you can follow along as we speak. Please feel free to send us any questions. We'd like to take questions as we go along, so feel free to post anything that you need to bring it to our attention. As Laurie said, today I have with me Linda Senior, a manager with our firm, and both of us are going to hopefully get you better prepared now should we face an economic downturn. I've been hearing a lot of that in the news, but we've been hearing that for a long time, that the big recession is coming again. We want to start off with a quote today. By failing to prepare, you are preparing to fail, by Benjamin Franklin. This is certainly true when it comes to economic downturns. Nobody likes to think about a recession. We all want to hope that the economic outlook will remain rosy, but in reality, downturns should not be ignored. The best time to think about a recession is before it happens. That means now. Let's talk a little bit first about what a recession is. By its definition, a recession is a period of declining economic performance across the entire economy, frequently measured as 2 consecutive quarters of economic decline, which is formally announced by the National Bureau of Economic Research. In other words, the government will announce when we are in recession. Economists say that there have been 33 U.S. recessions since 1854 through 2018, with 4 such periods of negative economic growth since 1980. Most well known that we just lived through, which seems like just yesterday, is the global recession in the wake of the 2008 financial crisis. And then our grandparents, great-grandparents lived through the Great Depression of the 1930s. Although recessions are unpleasant, a recession is a normal part of the business cycle. It is also a period of opportunity when a business is forced to clean house and improve its business practices. At our firm, we believe, why wait? If there's things that have to be done, let's talk about them, let's plan for them, and let's get them done today, which is why we are here right now. Why wait until the next recession? Why wait until the next recession to be declared? Let's think together now about how an economic decline will affect your business and what positioning you can do to mitigate the pain. We are going to go into the 3 key components to preparation for a recession: control cash flow, business planning, and focus on customer relations. Linda, I'm going to turn it over to you.
Okay, the first thing we're going to talk about today is controlling cash flow, because access to cash when you need it for your business is absolutely key. Before a downturn, there's some things that you can do. First thing is build up a rainy day fund, ideally 12 months worth, but if you don't have anything established, start off 1 or 2 months. Just as with a home budget, you need to be prepared in case that cash doesn't come through, in case you lose a major account of your revenue. Also, this will allow you to take advantage of opportunities you might run into during the recession that you wouldn't have, and also take a lot of the stress off of your business if for any reason the cash coming in is lower. Next would be securing access to a flexible line of credit or increasing your current line of credit. The best time to apply for any line of credit or increase is when the economy is strong and everything looks good. Even if you don't need it at the moment, consider securing financing that you can draw on when times are tough, and make sure that you're establishing a good relationship with your banker. In a previous job, I actually was the controller of a finance company, and right after 2008, we hit some difficulties, but because we had that good relationship with our banker, we were able to communicate, meet with them before the difficulties. They were familiar with our business. They weren't strangers. And once we did hit difficulties, we were able to renegotiate, make everything work, so both the business and the bank benefited. And even today, that company is thriving. One thing to keep in mind, banks will take away unused lines of credit. So every so often, you probably want to draw your line up to its limit, deposit the proceeds in another bank, and then pay it down within a month or so, just so you do have that full line of credit when you would need it in the future.
The key is always go looking for money when you don't really want it. These bankers can sniff it out when you're desperate for funds, and that is not the time to approach them. Get all your ducks in a row now with your financing. The cost on these line of credits just to maintain a zero balance is pretty low. But again, as you expand your business, you're always going to need money at one time or another.
Next, you want to pay off your business credit cards. So once you have that lower line of credit or lower interest line of credit set up, worry about using that instead of having a higher interest rate credit card debt that's also increasing the amount of cash that's going out of your company. So if you have a large outstanding balance, pay it down as soon as possible, or even look at consolidating your credit card debt into one card with a lower APR.
If you have made large purchases on credit cards and can't pay off the balance, that is probably a time that you should pull the trigger on your line of credit, because your line of credit interest rate is going to be much lower than the 18–20% that will be on your credit cards, and maybe refinance that onto a line of credit and even talk to your banker about extending the terms out if it was a piece of equipment or something that's going to last in your business for a long time, to get it on equipment terms instead of large credit card interest rates.
So now that you've looked at your cash, controlling your cash before the downturn, during the recession, there's a few more things you can do. You want to look at your accounts receivable and also your accounts payable. On your accounts receivable, make sure that you're being strict about holding clients to the payment schedules so that money actually comes in. Accounts receivable that's just a piece of paper for revenue doesn't mean anything until that cash hits the bank so you can actually use it. Rewrite your future policies, maybe shorten terms on those receivables. At the same time, look at your accounts payable. Maybe you need to request longer terms, rework those with the vendors. There's an alternative to the strategy we'll also look at when we talk about customer relations. Next, you want to draw on those resources you established prior to the recession, your line of credit, your emergency fund. Don't be scared to use your cash reserves or draw on that line of credit, because that's why you set them up. That's why you got prepared. Don't be reckless with your spending, but don't be afraid to use your resources. Before you draw on debt, though, you want to make sure to have a plan and a timetable as to how and when it will be paid back. So if you max out that line of credit, are you going to be able to pay it back, or is that going to make you shut your doors in the next 4 months? Another thing is to look at reducing your discretionary expenses. How much of your expenses are fixed versus variable? Do you own a building that you pay another entity that you own rent? Can you stretch out that rent payment? Do you have some flexibility there? What are your company's policies when it comes to travel, per diems, or office supplies? Do you have unnecessary travel that you can cut out? Some companies might have tickets or suites that are special entertainment for employees or customers. Does that still make sense? Especially since entertainment is no longer considered tax deductible, you have to look at, is it going to bring value, and is it going to help me grow my business? If you have extra office space, think about subleasing it to bring in some extra cash flow. And then really look at, are these expenses that I need or expenses that I want?
I think one good point that you brought up, Linda, was the fact of the fixed costs versus variable costs. I think it's very, very important for every business owner to know what is their fixed cost, what is my cost of doing business, even if I don't make $1 in sales, and try to get those costs to a minimum that you can. Fixed costs, if your fixed costs are extremely high, it's going to make it tougher in times of economic downturns for you to meet your bills. So I think, really laying out, or having your accountant lay out your financial statements with a page that says, this is the percentage of my costs, which are fixed costs, and this is my variable costs, and understanding what is fixed and what is variable and what can be cut out if times are hard.
That's a good point, Anita. Lastly, one of the things you do want to look at your inventory management. Are there ways that you can lower your inventory costs without losing quality or inconveniencing your customers? Are you holding a lot of inventory in a warehouse that maybe you can reduce how much you're holding and lower your warehousing costs? In some cases, explore drop shipping, or even changing a supply vendor that might help reduce some of that inventory cost. So now that we've talked about controlling cash flow, Anita's going to talk a little bit about business planning.
Business planning is great, especially if you have a vision for your business. Remember when you opened your business and what your dreams were? That was business planning. So always keep the dream alive, put it on paper, write it out, write the story that you want to live, especially as you know that recessions are totally normal. Businesses go up, businesses go down, sales go up, sales go down. So before a downturn actually hits, the first thing that we would like to suggest to you is explore new sources of revenue. It's interesting, as you read about companies that do well in a recession, the companies that provide non-essential services like marketing, for example, are typically the first to get hit in a recession. What happens when people want to cut costs? They cut out all their contractors. They're the ones that are easy to cut. They don't spend on marketing, and so that those people are the first to go. Unfortunately, where technically, if the business was planned right, the best time to market is in a recession, because that's when customers are looking for people like you and they want to buy from people. There are also many, many lines of business which are recession-proof. Some examples are like those that provide critical repair and maintenance services. The machines have to keep running regardless of whether sales are high or sales are low, or even selling essential items. Some good examples would be like a waste management company. Waste is produced every day. It has to be picked up and the streets have to be clean no matter what. Another good essential is a company like McDonald's or Myers or a grocery store. People may cut down eating out, but they still have to buy grocery because it's absolutely necessary to live. It's important for you to evaluate your operations and consider what new products and services you could offer to your current clients. By diversifying your revenue sources, you will both add new clients and earn more from your current client base. You may have some different service offerings that you could make, in that you could offer a cheaper version of what you're offering now, which would maybe turn it into an essential item rather than a non-essential item.
That's a good point, Anita. One thing to think about during a recession, are more people going to want a brand new loaded Lexus, or quite a few people will probably settle for a used Toyota, so that way they have that money to spend on something that's essential to them.
The second point that's very important is evaluate your business partners. If your suppliers don't supply to you, you are not going to be able to supply your customers, and that is going to hit sales and it's going to hit cash flow. Many businesses fail due to their heavy reliance on outside partners that they cannot control. And as these contractors are so valuable, but they are not able to service them, which will heavily affect the amount of sales volume that your business has. Take some time to evaluate and consider the strengths of your partners and vendors, especially the ones that you are economically dependent on for your sales, such as a supplier or a software vendor you heavily rely on. Are they vulnerable to economic downturns as well? You might think that your business is on solid footing, but outside factors can have a big impact on your operations. Ask for your vendor supplier credit reports and always seek out strong partners who are as equally prepared as you are for a potential recession. Always ask your vendors what their recession plan is. Take a look at their credit reports. You know, even just do a gut check. Is this the type of person that I really should be doing business with? Will they still be there for me when times get hard? The third point we have is test out lower priced goods or services. As Linda said, people may not want the high priced Lexus, but they might go for the cheaper model. Refine your product management strategy to switch up your offerings as sales orders decline in a recession, so that you can maintain your revenue stream and cash flow. Point number 4 we have is carefully consider any large investments that you are planning to make. You should always carefully consider these investments, whether it's in times of economic good times or bad. The timing of investments is key. Something that might be a fantastic investment during a time of economic strength could break your business during the recession. Anytime you're considering an investment, make sure you evaluate if your business can bear the financial burden in the face of an economic downturn. Work with your financial advisor. I always find that a good rule of thumb is to prepare a budget with sales at 75% to see if you can meet your bills, payroll, and debt service. What is the break-even point for your business? What is the amount of sales that you have to cover employee payroll and other fixed costs? And if it looks like you've got enough room, then commit to a large investment.
And as you'll see, a lot of these points really work together. So when we were talking about controlling the cash flow, setting up lines of credit, putting aside a rainy day fund, by having that line of credit and that rainy day fund, it gives you more opportunity to look at investments that might end up being a great deal for your business or a good way to grow and stay long term.
Right. Correct. Put some thought into your hiring practices. Before you hire new employees, make sure to consider the state of the economy. If a recession hits and you end up needing to lay off workers, this will have a big negative impact on your company's external reputation and its internal culture and morale. Worker layoffs make headline news. Also, think about your MESC liability and your costs, how much your employee costs are going to go up due to these unemployment taxes. If you end up underfunded in your Michigan unemployment account, they are going to increase your rate, and that increased rate will stay with you long, long after the recovery has happened. Always, always be sure to hire within your means. Your people are the lifeblood of your business. Without them or yourself, there is no business. Your business is only as good as the people in them. Always seek to hire resilient, optimistic, hardworking individuals.
There's that saying that you want to hire slow and fire fast. If you focus really good on that hiring slow, make sure that this is someone that you want sitting next to you through thick and thin. They're going to be the right person to help your business succeed and help your business grow. And you can see them sitting next to you in 10 or 20 years.
Thank you, Linda. Employee loyalty is very, very important in this day and age, especially to a successful business. The sixth point that we have is understand the tax implications of a recession. Work closely with your accounting advisor. Be sure to meet with your advisor regularly to understand what the future might look like in the event of a recession. Work with him or her to develop a solid tax plan. This is especially important if cash flow weakens, as taxes still have to be paid on declining sales volume. The unfortunate thing that happens is when sales go down, that means that cash collected goes down. Taxes have to be paid on those sales no matter what, but the cash flow goes to cover fixed costs, pay off suppliers for previously sold items. So the tax implications or the taxes tend to be the last thing to be paid. Unfortunately, if you don't have a reserve to pay them, you could find yourself on an installment plan with the IRS, and that is no fun. IRS will expect you to pay down your tax liabilities to $50,000 before they will even negotiate a plan with you. So having enough cash is what helps your business survive every day, especially when cash flow is weak. Consider asking your accounting advisor for advice to establish solid footing prior to a recession. Please, please, we can't urge you enough. Please pick their brains about any of the topics that we've spoken about so far. Your advisor is experienced and has seen them all, and always, always keep them in the loop.
We'd rather hear from our clients way too often than not at all. In fact, some of our favorite clients, we get to get grandbaby pictures, vacation pictures, and we want to hear from them good times or bad, because that way we can celebrate the good and help prepare for the bad and recover from the bad.
Throughout your preparations, make sure you remain focused on your long-term goals. Consider developing multiple business strategies, different strategies appropriate for different possible economic outcomes. Again, your business was a dream. Have your advisors help you to develop a financial budget around these strategies, dreams, so that you can be prepared for the real life outcome. If you have not already done so, work with your team to develop key performance indicators so that you can spot and react to trends very early in your business. think about what are the things that indicate to you things are going well and what are not going well. For example, daily sales, daily gross margin, man hours per machine. In our world, it's billable time, billable hours per FTE, collected rate. Whatever those 4 or 5 key performance indicators are for you, zone in on a daily report on those so you know exactly every day what your business is telling you. Spotting these key indicators will allow you to retool and control damage early for your business. Now, think about when the recession is actually here. What should you do? The number one thing that we feel is pay close attention to forecasting. Regularly examine short, medium, and long-term forecasts of the economic environment and adjust your strategies accordingly. Always, always use your rolling budget so you know where you're going to be with cash. And again, track your key performance indicators. Watch your KPIs. A KPI may be the amount of available cash per sales level, so you know where you are with what you have available to pay bills. This is another place where regularly being in contact with your accounting advisor would be very helpful to you. Also, consider what you can acquire during a recession. This one's perhaps a bit counterintuitive when you don't have much money to buy stuff and we're sitting here telling you to buy stuff. Assuming that you did a good job in preparing your business for the economic downturn, it's possible that you will be on a strong enough footing to use the recession to your advantage. For example, you could draw on your cash reserves to acquire a repossessed piece of equipment at a deep, deep discount. Alternatively, you could transfer extra cash to your marketing budget and increase your overall market share over competitors who cut their marketing efforts in the face of the recession. The best time to buy is when everybody else is selling. That is when you will get the best prices. Number 3, evaluate your workforce. Keep the high performers and consider trimming low performers to free up cash flow. If the low performers weren't doing anything for you, then why spend the money on them when you don't have the cash? You'll find that their work will be easily absorbed by your better employees because they weren't doing much anyway. Also, keep in mind reputation is important. Consider the impact of letting workers go and how that will affect you in your marketplace. Another point that I think is something that you can do now is to evaluate your debt. If you can afford to do so, pay off your debt aggressively to free up cash flow so you're always recession ready and you don't have any commitments on cash, especially as it's declining. The other piece too, depending what kind of entity you are, look at your payroll and see if you really need what you can survive on when cash flow gets tight, because the last person to get paid in a business will be the owner. Thanks.
Thank you, Anita. And well, now that we've talked about controlling cash flow, we've talked about business planning, now we want to talk about focusing on customer relations. So before the downturn, you want to look at your client pool. Just like when you were looking at your business partners, it's dangerous to be dependent on a small number of large clients or vendors, as your fate will depend on theirs in a recession. If they didn't prepare, they're now going to take you down or give you difficulties. So for example, during the Great Recession, would you have liked your main vendor to be, or your main client to be Lehman Brothers or Countrywide Mortgage? Where would you have been when you woke up 2009, 2010? Another thing is to maintain a focus on your core competencies. You're good at what you do, and that's why you're in business, providing that service or making that product. That should be your main focus. Diversification isn't a bad thing, but just make sure you're not sacrificing in your core areas where you're doing well just so you can grow others, try new things. Just like when we were talking about with looking at other lines, if you don't want to stop making those Lexuses or stop selling those Lexuses just because you're also selling your used Toyotas, you want to make sure that you're still have those options for your clients as well, because that's what they know you for. Look at strategies for winning over customers from your competition. Your customer service level might be just that step above where you can maybe pull in a new customer base, so that way you have that to rely on before that downturn hits. So once we're in the recession, you can get creative with collecting debt. We talked about shortening the terms on accounts receivable. Another thing to look at is cutting down those invoices. It's easier to look at several small invoices than a really large one. Think about doing monthly or quarterly billing if you normally do a once-a-year bill. Progress invoicing, so as a project is completed or services are provided, it would be easier for your clients to pay that smaller amount.
That's actually a very good thing to even think about now, is how convenient is your billing and collection process for your clients. The more convenient it is, the more likely they are to pay you. And it's easier, like Linda said, to pay a smaller bill than to pay a large one.
Another thing to look at is offering special discounts and freebies. You want to make sure that your customers know you appreciate them sticking with you even though times are tough for everyone. Whether it's card in the mail, promotional items that can be sent out, as your customers have that extra touch, it makes them feel special and it makes them feel valued. Don't cut back on marketing. Even in lean times, marketing is really important. You want to keep your name out there. If customers and potential customers or potential other business partners don't hear your name, they might wonder if you're even still around or if you got pulled down during the recession. All your future sales and reputation are always influenced by today's marketing. And this is before, after, or during a recession. Always, 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 when you're looking at your marketing, think about how this is a long-term strategy. This is not just putting money in the bank today. And lastly, really redouble your efforts to build strong relationships. Renew your networking efforts, looking at your biggest, oldest, and most loyal customers. Give them special attention and treatment in order to increase their loyalty. Also, look at focusing some attention on some of those key outside relationships, such as with your banker, with your suppliers. Building and maintaining strong relationships can make a big difference how successfully you weather an economic downturn. Also related to that, you can network through your chamber, Small Business Association in Michigan, all these different opportunities, because during a recession, everyone's having difficulties, but you might also be able to get an idea, something someone else tried that can help your business to succeed and succeed in the long run. If you continually improve your business processes and surround yourself with a good team, a foundation of advisors, your business will be more prepared for tomorrow than it was yesterday. And if you're properly prepared, a downturn can be a great opportunity to take advantage of opportunities and better position your business for the good times. A lot of these things come down to thinking, how is the decision I'm making today going to help grow or help my business succeed in the long term? And if you do have any questions or more information, please don't hesitate to contact us.
Thank you, ladies. Really good information. If there's any questions, please go ahead and post them now if you have questions for the chat. Do have a couple of you, couple of them. One was regarding fixed costs. You talked a little bit about reducing staff as a methodology to reducing your fixed costs. What other fixed costs do you see frequently that people can scale down or scale back, reduce?
One of them would be thinking now about owning your building rather than leasing from someone. That way, if there's an economic downturn and, you know, if you can get a good chunk of the building paid off, then you won't have that added expense every month. Always shop your vendor contracts. Leasing copy machines rather than buying, so you've got a smaller monthly payment. Telephone ends up being a huge expense in a lot of organizations, especially in the sales area. Looking at whether you're using traditional telephone lines or you're using what's it,
Voice over IP.
Yeah.
With current technology, there's so many options. If you don't have someone already within your organization, partner with someone that can help get you this information, look at it, because they might know of something that you're not even aware of. Actually, one of the good examples is the tool that we're using today for our webinar, Zoom. This wasn't widely known a couple years ago. So things change and you don't know, if you aren't aware of what's out there, you aren't going to be able to take advantage of it.
Right.
And also use the Small Business Association. You do a lot, FM does a lot of work in the energy space. Get an energy evaluation done on your buildings, because that could cut fixed costs in the long term. We're going through a procedure right now in our offices where we're trying to switch out all our lighting to LED, just to try to get some of those fixed energy costs under control. Small examples in that is putting those motion detectors so the lights aren't on when nobody's in the room. For $40, you can put a motion detector in.
Right, great. A lot of good things. There was another question that was related to, I think it was a statement that said, ask for money before you need it. Help us understand, is that asking for a line of credit so you have it before it's out there, or how does it work? Do you get a loan and just pay interest on it and put it aside in case you need it? What are your recommendations on that?
Bankers are more likely to listen to you when you have developed a good relationship with them over time. They like to be a trusted advisor, and they are a trusted advisor, but having a banker that you can just pick up the phone and say, I'm gonna do a $2 million expansion to my business, how is that all gonna work? That relationship is key. You always want to have someone that you can call that's gonna kick it in for you. Short-term financing, what we do in our business is we tend to empty out our bank accounts in December, and then our billings start again January, February, March. So cash tends to be a little light in a firm like ours for the months of January and February. What we do is that we have a line of credit that we have in place with the bank, and we really don't need to use it. But we don't want to give up having the opportunity to draw down several hundreds of thousands of dollars in an emergency, just in case, again, customers are slower at paying, because we still have to cover our payrolls. So what we will do is we will actually use our line of credit, draw it up to the maximum amount, deposit that money in a different bank somewhere else, and then pay it down after a month or so, because otherwise the bank, when they come in and reevaluate your line, they will say you're not using it, so we're either going to cut it down or we're going to take it away from you, because it's unnecessary for you to tie up our money.
And then going back to the original question, having that relationship with the bankers, they can best advise you what, in that case, does it make more sense to have a loan or a line of credit? From an accounting standpoint, we prefer lines of credit because lower interest rate and that long-term flexibility, but the banker they have forecasts that they see, what they're expecting, what their underwriting looks like. So having that strong relationship will also be a good person to go to for that kind of advice.
Very good, good. So now I'm going to ask you to look at your crystal ball. We've all heard the recession's coming. It's going to be here in a year, 6 months, 2 years, next month. None of us really quite know. In your expert experience, when should someone be doing this type of process? Should it be now, concerned that one's coming, or should this be a process that you do on a regular basis, review your business to see how well you're positioned? What are your thoughts?
I would say it's an ongoing process. I think you should be, when you sit down and look at your monthly financial statements, you should be reviewing it just to keep your business running as efficiently as you can. Obviously, like I said before in the presentation, what would your business look like if 25% of your sales didn't happen? Right. Could you still operate? Could you pay your bills? How is that going to affect your payroll and your personal lifestyle? Right. So I think you should be able to run your business with 75% of your sales and meet what your expectations are for your payroll.
Right.
And just like how you do other disaster recovery in case of a cyber event, in case of a natural disaster, just do a disaster recovery check or trial run in case of financial disaster. How would our business look?
Right. So what do we do? Well, excellent. I don't see any more questions. I'd like to thank you again. And I think you've proven the point. You've talked about a trusted advisor and a banker, but obviously a trusted advisor and a CPA is something that a business owner needs as a resource advisor, really as part of your team. So I encourage those that don't have one to seek one out. I can tell you that Lewis and Knopf has been a great partner of SBAM, offices in Flint, Brighton, and Benton. So use them as a resource. So thank you again, Anita and Linda, for being a part of this webinar, putting it together for our members. This webinar will be recorded and available on our website next week, and I will also send a PDF of the slides out
later today.
So thank you, everyone, and have a good day.
Thank you.
Join us for our next year's series. We'll have the dates out in a couple weeks. All right, thank you.
Thank you.
Bye.
Bye.